Good morning, I'm Nima, and this week's hot topic once again is Greece. Let's rewind to Tuesday as Greece formally announced it would not pay its €1.7 billion bill to the International Monetary Fund, which is due at 10 p.m. GMT. This now makes Greece the first developed country to do so and is the largest default in I.M.F history. But despite all the news, the markets actually remained relatively calm, and the Euro-USD was able to regain some of its 250 pip losses from Monday, while many global indexes like the DAX and the Dow Jones were able to regain some of their losses as well. Now, Greece's GDP accounts for a mere 2% of the EU's economy and only 0.03% of the global economy. So why are the markets reacting? Well, any developed country that defaults on a major debt, closes its banks, and is in the EU is bound to strike fear in investors and is bad for everyone. But the main reason why we are seeing concern from investors is simply due to the overall uncertainty of what will happen. In the US, the reason why stocks on Wall Street took a hit this week was related to the fact that the EU is one of the largest importers of US goods, so the uncertainty has US exporters worried. So, the billion-euro question is, what's next? Well, last Friday, Greek Prime Minister Alexis Tsipras announced on a referendum for July 5th, which will test whether Greek citizens want to stay in the Eurozone and accept the terms offered by its creditors. If the people were to vote no, it would simply mean that they do not want to consider the bailout. Chaos could ensue, as the next step would be on how to leave the euro and return to the drachma after a 13-year hiatus. If the people are to vote yes, it likely means that they want to stay in the Eurozone, but new terms would need to be negotiated. So let's take a look at what's actually happening inside of Greece. Well, the banks are still closed. This measure was done in order to prevent people from withdrawing all of their cash due to the uncertainty. Withdrawals are limited to only €60 per day. In fact, since the Syriza party came to power 5 months ago, Greeks have already withdrawn a staggering €30 billion from the country's financial institutions, further compounding the fact of Greece's severe depression. And things can get a whole lot worse before it gets better if Greece leaves the euro. A new drachma would be worth much less than the euro, and some analysts expect a devaluation of around 50%, meaning the cost of imports would rocket, which could send inflation soaring. Now, what dates should we be watching out for this week? Well, today, July 2nd, the U.S. non-farm payrolls will be announced a day earlier. This is due to the U.S. Independence Day. Analysts were expecting a range between 220,000 to 235,000 new jobs created. And on Sunday, July 5th, we have the Greek referendum. Will it be a yes vote or a no vote? Comment below, tell us your thoughts. My name's Nima, you've been watching The Hot Topic.